Almost every business owner thinks about exiting the same way. You just build a business, run it, get it profitable, and then list it and sell it for a market-dictated multiple of what it makes. It sounds reasonable, but it's the reason 80% of businesses that get listed for sale never actually sell. It's not that there aren't buyers. There are plenty of buyers. Private equity is sitting on record amounts of cash right now, hunting for deals. But the reason most businesses don't sell is that they were never built to be bought in the first place. They were built to be run. And building a business to run and building a business to be bought are two completely different things. I've started over 20 businesses, exited 6 of them, including an IPO with Merrill, Lynch, and Solomon Smith Barney, which ended up with a sale to Sprint, who eventually became T-Mobile. And on the other side of the table, I've personally acquired close to 20 more. So I've been the founder building it, I've been the seller closing the deal, and I've been the buyer running diligence on someone else's life's work. In this video, I'm going to walk you through what private equity actually looks for when they're deciding which business to buy. The exact 6 traits that make a buyer compete for your deal instead of you chasing them. The everyday mistake that signals to a buyer your business is not buyable, even when it's profitable. And how to start architecting those traits now, whether you're planning to sell in 2 years or you never want to sell at all. Before we get into the list, I need to show you the biggest mistake most people make when trying to sell their business. Because every owner I talk to walks in believing the same thing about what their business is worth. They think a business is worth a multiple of what it earns. So they look at last year's EBITDA, they multiply it by whatever number their accountant or their broker quoted them, and they expect that that's the check that shows up after the deal is done. But that's not how a buyer thinks. A business is worth what a buyer can verify it earns and what they believe will transfer to them once you, the seller, are gone. Verifiability and transferability. Those 2 words are the whole game. Verifiability is whether a buyer can actually prove your numbers are real. Transferability is whether the business keeps running with the same customers and the same revenue after you leave. Every single one of the traits I'm about to walk you through is either a verifiability or transferability rule. Because when they're all in place, a buyer will gladly pay more for your business. But when any one of them is broken, the deal either gets renegotiated, restructured with conditions, or it just dies. At the top of the list is revenue quality, and specifically what portion of your revenue is recurring versus everything else. Because when a buyer is looking at your top line, the first question they ask is how much of this is going to still be here next year without anyone having to go out and sell it again. Because that answer determines how much of your business actually transfers to them at close. There are really 4 tiers of revenue from a buyer's perspective. At the top is true recurring revenue. These are your subscriptions, maintenance contracts, SaaS-style arrangements where the money comes in automatically every month or every quarter without anyone lifting a finger. That's the gold standard. And when a buyer sees a high portion of true recurring revenue, they get excited. Below that is contracted repeat revenue. These are clients on multi-year agreements, renewal provisions baked in. It's not entirely automatic, but it's contractually structured so a buyer can actually underwrite it. Below that is expected repeat revenue. Customers who keep coming back because they like you and your product, but there's no contract holding them there, right? The relationship is there, but it's not enforceable. A buyer discounts it from contracted repeat, but it's still better than the bottom tier. And at the bottom is project revenue. This is one-time work that doesn't repeat itself on a regular basis. And there's nothing wrong with it. As a business, that's fine. But a buyer can't trust it to continue after the deal is done. The classic example I give is a typical roofing company versus a pest control company. A roofer sells you a roof once every 20 years, but pest control comes to your house every single month. These are 2 completely different business models to underwrite as a buyer. Here's the benchmark I usually use. Anything under 20% recurring or reoccurring revenue is hard to put additional value on. 20% is where it starts to matter. 50% is where it starts moving the valuation significantly. And above 70%, that's where buyers actively start chasing you. And the reason this is trait number 1 is that revenue quality is the cleanest possible transferability signal there is. If your revenue is contracted and recurring, that revenue transfers once they buy your business. Trait number 2 is owner dependency, specifically the absence of it. And paired with that, a strong number 2 already in the business who can run the day-to-day without you. Here's the test I give every owner. Could you leave your business for 4 weeks? That means not touching your phone, checking your email, or fixing small things with your staff, and come back to find the business running exactly the way you left it. If the answer is no, you have owner dependency. And owner dependency is one of the fastest ways to lose a deal. The everyday wrong version of this looks a few different ways. Maybe you're the only one in the business who's licensed to do a certain job. Maybe every key decision still flows through you, or your team isn't empowered to handle anything material without your sign-off. Maybe you genuinely cannot remember the last time you took a real vacation without your phone going off every hour. From a buyer's perspective, that's not a profitable business. That's a job you built around yourself. And the moment you walk away, the business goes with you. I'll give you a real example. I was looking at a portable toilet or a porta potty company in South Florida. This was a great business on paper with recurring revenue, a year-over-year growth, and the kind of business that doesn't go anywhere. But the owner literally did everything except drive the routes. All the bookkeeping, all the decision-making, all the provisioning, all the accounting. He was working 70 to 80 hours a week. He hadn't been on a real vacation in years, and that was actually why he was selling. He was just burnt out. His margins looked incredible. But the reason his margins were incredible was that he hadn't hired anyone. Every dollar of payroll he should have been spending was going into his pocket as profit. I couldn't get comfortable with the idea that the business would survive him leaving. So I walked away. Now here's the second half of this trade. Even when the owner steps back, a buyer still wants to see a strong number two already in place doing the work. Someone who's capable of running the business on a day-to-day basis, the day after close, and who's committed to staying. You can have no owner dependency and still not have a clear number two. And when there's no clear number two, there's a void the moment the seller leaves. A buyer has to either bring someone in from outside, which is both a risk and a cost, or watch the business deteriorate. When a buyer sees owner dependency and diligence, one of two things tend to happen. Either they walk, or they restructure the deal with a significant earnout that ties the seller into the business for years after the deal. The second one is what I call the earnout trap, because you think you sold your business, but what you actually did is sign yourself up for another 3 to 5 years as a paid employee, with most of your money locked up in performance hurdles. And this is the trait that matters most for the owner, who never wants to sell. Because when you fix owner dependency, you stop being a prisoner to your own business. The business keeps running while you're at your kid's soccer game. Trait 3 is customer concentration. The everyday wrong version looks like this. One customer is 30% of your revenue. Maybe you've been with them for years. Maybe they're the customer who helped you scale in the early days. And on your P&L, that single customer looks like a huge win. But to a buyer, that single customer is a huge risk. Because if they leave 6 months after close, a third of the business they just bought from you is gone. Anything over 20 to 25% of revenue from a single client is typically considered a client concentration. But it's not just one client. 3 clients at 15% each give you 45% of your revenue concentrated in 3 relationships. That's also concentration. The test isn't whether any one customer hits the threshold. The test is what portion of your revenue is tied to a small handful of relationships. When a buyer sees that in diligence, the deal usually does one of 3 things. It either dies, it gets aggressively renegotiated because the buyer has to underwrite the deal assuming those clients walk after the close, or it gets restructured with conditions. I'll give you an example of the third one. A few months ago, I was looking at a fitness business. It was genuinely a good business, but the problem was that 70% of its revenue came from 2 clients. I wanted to do the deal, but I couldn't underwrite that kind of risk at the price the seller wanted. So I went back to him with a structure, a forgivable seller note tied to those 2 clients staying on for 36 months. If they stayed, he got paid in full. And if they left, the note got partially forgiven. And the price came down to reflect the business he actually sold me. He wasn't willing to take that structure, so I walked away. The business itself was great, but on this one trade alone, the deal couldn't close at his number. And from a transferability standpoint, this is the cleanest version of the test. If a customer leaves, does meaningful revenue leave with them? If yes, you have concentration. But if the answer is no, then you've diversified. Trait 4 is clean and reliable financials. This is the verifiability side of the lens. Because no matter how good a business looks on the outside, if the buyer cannot independently prove the numbers, the deal doesn't close, at least not at your number. There are 4 versions of messy books that I see again and again. The first one is commingled financials. Multiple businesses running under the same roof, sharing expenses, sharing staff, sharing office space, and the way revenue and expenses get booked changes depending on who's doing the entry that month. When a buyer opens those books, they can't tell which business is actually making the money. The second is a chart of accounts that keeps moving. These are categories that get renamed, expenses that move from one line to another, or you can't follow a trend across years because the buckets keep changing. The third is the P&L and tax returns are telling two completely different stories. Things like different revenue, different expenses, different bottom line, and no clear explanation for the gap. If you can't explain in a way that your buyer can verify why your books say one thing and your tax returns say another, you have a problem. And the fourth is aggressive add backs. The seller's been told to adjust EBITDA up by adding back every personal expense, every one-time cost, every gym membership, and every family vacation. When a buyer asks for documentation, there isn't any. Here's the part most owners don't see coming. The number one reason books and tax returns don't match is the tax minimization strategy. These are cash payments that didn't get recorded, personal expenses run through the business to lower taxable income, but every dollar you successfully hide from the IRS to save 30 cents in tax will cost you $5 to $7 at exit. I'll give you a real example on this one. I'm looking at a property management business in the Pacific Northwest. The owner had originally been a multifamily developer. He couldn't find a good property manager for his own buildings, so he started his own property management company, and it grew. He also still had the development business and the construction business, and all three ran out of the same building with the same staff. The business checked a lot of my boxes. It had recurring revenue, a strong number two, good clients, clear growth, but the financials were commingled. All three businesses rolled up into one tax return, and the P&Ls he gave me for the property management business were allegedly separate. But at the end of the day, every expense had been split by his bookkeeper using her methodology. For me to get comfortable, I would have had to trust the math. But I can't underwrite based on trust. I have to underwrite based on verifiability. So we ended up walking away. Quick one before we get into the next two. If you're watching this and starting to wonder where your own business actually sits on this list, I put together an exit readiness scorecard that includes these exact 6 traits as well as several others. These are the same traits that a sophisticated buyer is scoring you on. You can self-score your business against it in about 5 minutes and see where the gaps are. The link's in the description. Now let's keep going. Trait 5 is positive year-over-year growth on both the top line and the bottom line, with no down years over the last 3. A buyer is not just looking at your most recent year, they're looking at the trajectory. They want to see revenue up, EBITDA up year over year with no surprises at all in the middle. Because let's say you did $1 million in EBITDA in 2023. You did 1.3 million in 2024, and then 2025 dropped to 900,000. And now you've decided that's the year you want to sell. To a buyer, that down year doesn't just reprice the deal off the lower number. It reprices the deal off uncertainty about where the bottom actually is. They have no idea whether 2025 was a blip or the start of a trend, and they have no idea what's causing it. So they have to be conservative. Best case, they price you off the down year and discount it further to protect themselves against another bad year they can't see coming. But usually, they'll just walk away from the deal altogether. And the underlying logic is the same as everywhere else in this list. The buyer is trying to figure out what transfers when they decide to close the deal. A clean upward trend tells them the business has momentum that's likely to keep going after the close. But a messy trend with a down year in it tells them the opposite. And that will cost you lots of money, or likely the deal itself. The fix is simple, but it's a bit harder to execute. You have to time the exit off your strongest trailing 3 years, not your weakest. Selling in a down year because you're tired or burnt out is one of the most expensive decisions an owner can make. Trait 6, the owner's manual. Trait 6 is documented systems, SOPs, an owner's manual for how the business actually runs. Because let's say you have a business where every procedure lives inside someone's head. Not just yours, your operations manager's head, your top tech's head, your bookkeeper who's been with you for 14 years and knows every weird vendor relationship. The business is running great because those people know what they're doing. They've been doing it forever. No document explains how any of it works though. To a buyer, that's a wall of single points of failure. The operations manager can win the lottery and decide to quit tomorrow. A key tech can get sick and the whole company goes under because they don't have the documentation to fix things when they go wrong. Or your bookkeeper finally retires. Each of those is a hole in the business that nobody else can fill because the playbook for filling it doesn't exist anywhere except in the head of the person who's leaving. This is pure transfer risk. The buyer is trying to figure out what they're actually buying. If what they're buying is a stack of human knowledge that might walk out the door, the answer is not much. When a buyer sees real documented systems, real SOPs, a real owner's manual for the business, they get excited because every system you've documented is a piece of the business that transfers cleanly, regardless of who's in the seat. And here's the bridge back to where we started. Every one of the 6 traits we just walked through is either a verifiability signal or a transferability signal. Each one tells a buyer something different about how much of your business will actually remain after you're gone and how much of what you're telling them they can actually prove. That's why a buyer pays a premium for one business and walks from another that looks identical on the surface. Section 8, when to start architecting these in. One last thing before we wrap. If you're early stage, you're 1, 2, 3 years into building and you don't have an exit on the radar, none of this feels urgent yet. But please build it the right way from the beginning, because every one of these 6 traits is significantly cheaper to architect in on day 1 than to fix in year 10. You don't have to choose between growing and being exit ready. They're part of the same project. And if you have no plan to sell and never want to, this list still matters to you. Because an exit-ready business is just a better business. It makes more money, it carries less risk, it runs better, it requires less of you, and you stop being a prisoner to your own business. You can take a vacation without your phone going off every hour. You can take a Friday off. Owner dependency is the one that matters most for you specifically, because the day you fix it is the day your business starts giving you your life back, even if a buyer never knocks. Now you know the 6 traits that make a buyer chase your deal instead of you chasing them. The next obvious question is what those traits actually translate to in dollars when a buyer puts a price on the business. So click this video here because I want to walk you through how to value your business in 2 minutes using the same lens a buyer uses, not the rule of thumb multiple your accountant keeps quoting you. If this video showed you what makes a business buyable, this one shows you what it's actually worth when it is. I'll see you there.